Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors. Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines and many other sectors.
In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is a special edition where our focus is on the Q3 earnings. The company on our radar in this special show is Teamlease Services. The company has reported its Q3 numbers with the top line increasing 22% and the profits increasing 7% on a year-on-year basis as well. Now what we've also seen is that sequentially the revenues have grown 7.6% and the profits have increased 13.6% as well. The EBITDA margins have come in around 1.5% as well. And there is a steady show in a lot of segments that the company has reported. To discuss more insights on the quarterly earnings as well as an outlook going forward, I'm now joined by a very special guest, the top management of the company. Ramani Dathi joins in. She's the CFO of TeamLease Services. Ramani, good afternoon and thank you so much for taking the time out for this discussion on the Q3 earnings. Help us understand first up, how would you really assess the Q3 numbers that have come about, and could you also give us a breakup of the performance of the various segments that have come in this time?
Sure, Sakshi. So as we have indicated earlier, now we are back on track in terms of our profit expansion quarter on quarter. So there are three measures that we have focused on over the last few quarters. So one is clearly consistent revenue growth. So we have managed to fix the sales rigor. We are consistently adding headcount numbers in our general staffing business and expanding the revenues upwards of 20% annual growth from the last few quarters, and that would be maintained into future as well. Secondly, a very tight cost control, because in the past, one of the reasons for our margin dilution is also a slight increase in our cost structures, also coupled with drop in margins of other higher margin segments. But now with a tighter control on cost, we have managed to expand profits considerably over the last couple of quarters and will maintain this kind of operating leverage driving into future as well. The third element is also the fact that other business services like our HR services has now started adding decent profit margin quarter on quarter, and Q4 being the maximum addition coming from the segment, we are positive that the overall full year profit expansion would be decent at a EBITDA level.
Okay, wonderful. If you could tell us, what has been the hiring trend this quarter for various sectors that you deal with, especially with the IT space, because in my conversations with the top management, there still seems to be a little cautious stance when it comes to hiring going forward from here. What is the sense that you have picked up? How was the hiring this quarter and what's the outlook?
You're absolutely right on that point, Sakshi. On IT front, in fact, IT is the lowest hiring segment for us across all other industry verticals. And this is the case for the last 3 quarters as well. And it may continue for a few more quarters because at this point in time, we are not seeing any kind of green shoots, especially on the IT services front. Having said that, the tech hiring in GCCs and captives is somewhat encouraging. So we are adding considerable headcount on GCC front. But compared to the volumes that IT service companies hire, this is just like a fraction of that headcount. So this really can't change the headcount and hiring trend within IT. Other than
Okay.
IT, for this quarter, we have seen good amount of hiring all other segments, be it retail, consumer, pharma, education. So we have seen good hiring trends. BFSI is kind of fade a little below our expectation. That could also be because of few advisory restrictions on unsecured loans under 50,000 by RBI. Barring that, rest all industry verticals, barring IT and BFSI, rest all industry verticals fared well for us.
Okay. What about in startups? What's the trend that you're looking at? Of course, there has been, a year and a half of pain for the entire startup industry with the valuation markdowns really happening and, of course, funding crunch being a key issue. There was constant talk of layoffs happening since the last 1.5 years as well. Do you see some of the pain ebbing now at this point in time, or do you still feel that this space is in for some volatility going forward?
Yeah, this trend will continue for some more time because for last 1 year there is almost no hiring that we have done for startup space. We used to have 2 to 3% of quarterly addition going into startups before FY23, but over last 4 quarters it's almost kind of flat, and even the replacement hiring for attrition, the backfilling of attrition in startup, even that those numbers have come down. So they may not be laying off in huge numbers, but they are not replacing the attrition headcount. That's also leading to drop in overall headcount in startup. And as I mentioned, at this point in time, we are not seeing any visibility in terms of recovery in hiring trends for the startup space. Maybe some e-commerce companies, yes, but otherwise the edtech companies, fintech companies may continue on hiring freeze for a few more quarters.
Okay, there could be some more hiring freeze that we have to see for some more time to come in the startup space. What about skilling and upskilling? How has the trend been in this quarter for skilling and upskilling? Again, in my conversations with the top tech firms, they were constantly talking about Gen AI. That has been the big buzzword, and they were saying that they're looking at skilling their own employees and upskilling their own employees to shift to some of the Gen AI segments as well. What's the trend that you're picking up?
Yeah. No, let me split this question into two parts. So
Sure.
one is regarding Gen AI, the impact of Gen AI on replacement of jobs or creation of new jobs. So we have to wait and watch because at the early stages of be it big data or blockchain technology, the interpretation was that it will replace lots of jobs or it will create new segment of jobs. But in reality, that didn't happen at the kind of expectation that was there initially. So
Yeah.
even with Gen AI, we have to wait and watch because once we actually take it to implementation and execution level, so there will be challenges. And on that part, we believe that it may not pose any immediate threat to the jobs and the current skill set, especially on the IT side. So coming back to the in general, the skill enhancement, definitely there is a skill gap. If we look at industry segments like manufacturing and engineering, so there is a huge gap because majority of the candidates that we are taking to these clients are graduates, but they are not ready for directly taking them on the shop floor. So they need skill enhancement, be it training or on the job or maybe blended with their curriculum. So those kind of changes have to be made at policy level, and short-term interim trainings we are doing in other industry verticals, which to some extent are effective. But as far as manufacturing is concerned, it has to be baked with on-the-job training, something like an apprenticeship programs or long-term education-linked training programs might help.
Okay. Let's talk about the margins then. For you at this point in time, what is the comfortable band that you are working with for the upcoming 1 or 2 quarters? And for the entire fiscal year 2025 then, how would you really look at the expansion on this level?
Yeah. Now, while we are very confident on absolute profits expansion quarter on quarter, as a percentage margin, it's very difficult for us to give any kind of guidance because At top line, the salaries are a pass through, and we have no control on that part. So that's kind of, especially in general staffing business. So for us to give a guidance on percentage margin is difficult. The second element are higher margin businesses like the IT staffing and apprenticeship business. Both are kind of at a lower end of hiring right now, and they are
Yes.
impacting our margins. So taking these aspects into consideration, we are looking at least a 10 basis point margin improvement next year, quarter on quarter next year.
Okay. And on the top line and the bottom line, what is the internal targets, if you may have set for yourself for the next year? Do you at least hope that FY25 would perhaps be much better than what FY24 has been? A lot of pain would start to ease after 2 or 3 quarters from here ends.
Yeah. As far as top line growth is concerned, we are very confident of maintaining a run rate of 20 to 25% CAGR.
Okay.
And that comes with the fact that we are able to hire 18 to 20% annual growth in our general staffing business. And at margin level, as I mentioned, with economies of scale coming from general staffing business and contribution from HR services, we can expand margins maybe 5 to 10 basis points sequentially next year. With IT recovery, so we can get back to our previous EBITDA margins of 2% plus.
Okay, fair enough. Well, on that note, thanks a lot, Ramani, for being with us and sharing such wonderful insights with all our viewers. Here's wishing you all the very best for the upcoming quarters and hoping for more interactions to get better insights about the earnings and your company also going forward.
Thank you, Sakshi.
All right, with that, we wrap up this very special conversation with Ramani Dathi. There is a promising outlook over there, and 10 basis points of a margins expansion that the company is looking at, next year, same quarter as well, about 10 basis points or so. And the top line CAGR growth of 20 to 25% is what the company is confident of achieving. Of course, a lot depends on how the recovery really happens in the IT space, which is their higher margins business as well. We'll continue to keep an eye out on the developments going forward, but do stay tuned. A lot of earnings interactions follow up right up next on your screens.
Darwin Platform Group of Companies is one of the fastest growing diversified Indian conglomerates with global footprints. It is setting up offices globally and tying up with companies across the globe from multiple sectors. The company has ventured into real estate and construction, stockbroking and finance, arms and ammunition, mining, airlines, and many other sectors.
In today's rapidly evolving business environment, when risk is omnipresent, managing risks is no longer just about ticking a few boxes. Businesses need to maintain a panoramic view of risks to stay ahead of the curve. Join us to explore how organizations can rethink risk to unlock new possibilities and become fit for future. At PwC presents De-Risking the Future in collaboration with Business Today.
What do you think of as the one big failure, what you'd accept as a